It's only my 1000th Zoom call, yet apparently still having some hiccups. So, all right, moving right into the action. This is really the conclusion here. We ran through two scenarios, and here they're called S2 and S4. We maintain those names because we want to be very transparent that what we're using here are economic scenarios provided by Moody's Analytics. Moody's Analytics is headed by Mark Zandi, an economist that I know personally and hold in great reverence. Most of the folks in this committee likely know Mark Zandi as well. He's on CNBC, top national economist, great firm. But what we really liked about their approach is early in February, they actually brought on a team of epidemiologists and put them together with their economic staff and actually began to amend their pure economic models to include some of the models and some of the feedback from the epidemiologists, so they could really model very quickly some of the economic impacts and some of the relationships to what the epidemiologists were thinking. So, they have resources that we can't match. Typically, we do our own economic outlook, but at this point in time, we felt it was proper to piggyback on their forecast. They have a baseline forecast, and then they had these different scenarios. So we selected S2 and S4. S2, both are more pessimistic than their baseline scenarios, okay? And these baseline scenarios were put out in early April. So it was based on, information at that point in time, or even really several weeks before. So far, it looks like we made the right choice. The unemployment numbers so far look closer to between our S2 and S4 scenarios, certainly than it did to their baseline. So I think we were right in selecting those two scenarios, but I do want to be upfront that we took a more pessimistic approach than what Moody's was thinking in their offset there. And again, so far that looks to have been the right choice. Also, as we go through all of this, and we made a great point of this during our presentation, just to highlight the uncertainty. There's always uncertainty in looking forward, obviously, but never has there been this degree of uncertainty.
They ordered them, paid for them, they didn't want them.
Medical uncertainty, you have economic uncertainty, you have the near-term uncertainty of how government policies are interacting with the economy in terms of both the stay-at-home orders, as well as many of the programs to put cash out into the economy. You have the uncertainty related to how the recessions will play out. And then, of course, you have the uncertainty of how is the economy going to react to all of this. And we know historically that pandemics have caused extraordinary reactions to the economic times. These are impacts of extraordinary significance, and businesses and consumers will forever be changed by this. The question is how, when, and to what degree. And those are the items that nobody can predict, So as I go through this, I feel like this gives you an excellent range of likely outcomes, but I don't want to pretend that there aren't ranges that are outside of this, and it's critical to acknowledge the uncertainty. So in the near term here, we show a band of fiscal 20 between 900 million and 1.1 billion. Okay, in fiscal 21, those numbers increase to down 2 billion or down 2.6, somewhere in that band, and then out in fiscal 22. The budget that, who knows at this point, but in normal times, you all would be considering at the beginning of next January, this coming January, between 2.6 billion and almost 4 billion. So we're talking about extraordinary numbers. These dollar differences are relative to the budgets that were just passed this past session. So in theory, these are the bogeys that you would be looking at the next time that you all convene to deal with budgetary issues. You'll notice that fiscal 20 is significantly less than the worst case scenario that I had rolled out what was now about 7 weeks ago. And I'll go into that to some extent because there's both good news there, as well as I think some important timing discussions. But you can see here percentage-wise, you all will likely be facing some very difficult questions in the near future. Let's see. All right. Moving on, this first chart here, I think really shows, I'm going to show you a lot of charts that are going to show you how exceptional these times are. These are the initial unemployment claims, and through the 8th week, this hasn't been updated as of the most recent claims, but just under 500,000. Extraordinary. We get there in 8 weeks. During the dot-com bubble and burst, we never even got there. We hit a total of 116,000. And then during 2 recessions that had great impacts on Maryland, the Great Recession in the early 90s, it took 1.5 years to get to that number. Okay, so not only are we besieged here by the number of people impacted, but we're besieged by how rapid the impact is, and of course this is all well known at this point in time. But the pace at which the onset has occurred has economic implications as well, right? And it's something that again is unprecedented, and we'll have to see how that impacts us. The reason that fiscal 20 no longer looks like that worst case scenario of 2.8 billion is because our withholding has kept up. Withholding is the most important, single most important component of our revenue. It is, the percent that is withheld by employers based on workers. So it's directly tied to labor income. It makes up 45% of the general fund in itself. Okay, 45% of the general fund. Nothing matters more than withholding. It's not our most volatile component. You all know that as capital gains, and you've taken some great actions to help support that over the last several years. But withholding is the single most important. And in my worst case scenario estimate, I estimated that withholding would fall as much up to 22% as a result of this. And as you can see from that unemployment, we've put 500,000 Marylanders out of work, which is almost 25% of employment. And it would make sense then that we would see wages fall in a similar order. What's illogical is that they haven't. And that's what you see on this chart here is you can see in the gray shades are several key events. This is year-to-date withholding, which, because it's very noisy, this helps to minimize some of that noise. But you can see that withholding hasn't actually decreased. And we've spent considerable amounts of time trying to understand why that is. What's illogical is that my worst case scenario is that we're not closer to that. And we can't be certain as to why, but I think this is an important part of the discussion, and we speculate that one cause is that the timing is different than what I had initially thought. I think there is a longer period of time from when an hour of work is completed to when we get that withholding. So that likely creates, it's likely that lag, especially for our larger employers, is probably about 3 weeks. So perhaps there's about that 3-week lag. There's also a lag of time between when an employer makes a decision about employment. So what I mean there is an employer is looking at conditions on the ground right now, and they're planning what's going to happen over the next 3 weeks. So, the decision of employment hours was made 3 weeks before those hours were worked, and then we get the withholding 3 weeks after that. So, there could be a much greater delay in the impact than what I initially suspected. 2, and I think this is perhaps more important, is that employers came into this with strong balance sheets. Throughout this entire economic expansion, we talked a lot about all of the cash that was sitting on companies' balance sheets. Companies weren't investing it. And so while that was a negative at that time, it may be a positive at this moment to where companies were able to maintain their payrolls for a longer period of time. And if you couple that with another common refrain during the expansion, which was that companies couldn't find skilled workers. They were always hard up to maintain their labor force or to grow their labor force. So perhaps during this contraction, they have an even greater incentive to hold on to those employees to which they've invested a lot of time and resources to train up. So if you couple that need for maintaining those individuals with the strong balance sheets, you might find that there's, relative to prior other recessions, companies might be better suited to maintain those payrolls. You've also got the federal PPP program, which we know has worked to some degree. It's not perfect, but it has put a lot of cash out there with incentives to maintain payroll. And then the state and many local governments have also offered incentives as well, and those are at play. So perhaps some of those incentives are having a positive impact to keep payrolls up as well. But I will tell you, I still can't explain the fact that it's growing. Even under all of those options out there, I'd certainly be expecting to see us contracting and withholding by several percentage points. And the forecast that we put forward does see withholding turning to a contraction for the rest of this fiscal year. So we do have that built in, but not to the degree at which we did in that worst case scenario. So, I think this is good news. This here is good news, especially in the near term. But again, I do expect this to turn to declining withholding in the near future. Moving on to the forecast and what variables we're using. This is US GDP, the year-over-year change in the S2 and S4 scenarios, as well as some history. And the slides I'm going to show you throughout go back to show the Great Recession, so you can see how this compares. And the Great Recession, you can see back here, contracted at an extraordinary rate. Two quarters directly, 3 quarters of negative contraction, but 2 quarters of about negative 3.5%, 4% there, compounding. So very deep contraction there. It's called the Great Recession. It's capitalized because it's a once in a lifetime occurrence. But here we are. And the S2 scenario is double the impact of the Great Recession. The S4 is almost triple. So that's what we're facing right now. We are facing scenarios that are 2 to 3 times worse than the Great Recession. And this is a point at which I think it makes sense to discuss, what sets this aside. And, typically recessions are caused by what we call either the real economy or the financial economy, but they're business cycles. It's the nature of capitalism, the nature of the Federal Reserve, the nature of individual businesses, that during periods of expansion, monetary policy and the economics and decisions of individuals will not be perfectly in sync. And we will have the types of items that cause recessions, which are typically misallocations of capital. So we misinvest in one segment of the economy, typically, driving up asset prices in a way that we shouldn't. And then we get that correction. And that's the regular business cycle. It's to be expected. It's what we've been discussing for the last several years as possibly being on the horizon. And then you go into recession where you correct those, and then we come back out. But this is not a recession that's being caused by this. This is something that is completely outside of the economy is causing this. And that's why we have that sharp downturn. But this will expose the business cycle that was building up in the underlying economy prior. So, whether it is too much investment in fracking and the oil economy, we know that we're piling on debt at our business entities because borrowing was so cheap for such a long time there. That's likely going to be exposed during all of this. So what you see here are orders of impact. And initially, the downturn is the shut-in. So we've literally shut down almost the entire American economy for 1 quarter. That causes the drop. A slight bounce back in the 3rd quarter as many businesses get back to work. And then you start to see the recession turn into the broader economic downturn that would be more normal. So we will see some of those impacts playing out in the third, fourth, and then into 2021 is what these scenarios show. So it's really a double impact. It's something outside of the economy, and then it's the economy. Looking at how these scenarios compare, Maryland versus the US, as you'd expect, we don't fall as far during the recession and we don't grow as fast afterwards. This is our MO. It is Maryland. It is because of feds, meds, beds, and eds, something I've always been a strong proponent of. It does limit our ability to grow, but it also limits how far we fall. So it is the strength of our economy. And that's why these scenarios, Maryland does not decline as far as the national figures do. So this is the S2 scenario. This is the S4 scenario, okay? The takeaway here is that we're not falling as far, but now it makes sense to compare the two. So here's S2 and S4 compared, and this is an indexing chart, which means that I'm comparing each of these points in time to their prior peak. So in this case, we're looking back to 2019 Q4. That's going to be the prior peak before this recession. You can see there's a slight contraction in Q1, and then Q2 is the heart of the downturn. It maxes out at down 8% for S2, and that is occurring right now. Then the slight bounce back and the expansion. S4, the significant downturn, the slight bounce back, but then a very protracted contraction that lasts all the way until the second quarter of 2021. So this goes on a full year from now. We end up losing 12% of our full state GDP and then beginning the process of rebound. And something to point out here is there's been a lot of discussion of shapes of the recession and the recovery. I look at S2 as being either a U or a W, depending how you want to characterize that. The W being because you have that slight upturn before another down. Whereas S4 looks like the Nike swoosh, right? You have the downturn, and it's a projected downturn, and then the comeback. And in Maryland, we don't like to give Nike any recognition, right? We're an Under Armour state, but it sure does resemble their logo. And what you'll notice here is we don't have a V, and that's the other shape that's discussed. The concept of the V is that basically right after the stay-at-home order, we'll bounce right back, and it won't trigger other economic implications that create these lasting impacts, and we'll be right back to normal. I don't believe that scenario to be an opportunity at all. I think it's at least to some degree what the stock market has priced in right now, which is why the stock market has held up so well. But it's worth noting, the market is pretty prescient and is full of a lot of very smart people spending a lot of money on resources. So it's worth noting that there is a strong viewpoint out there that you could see a V, okay? It's not something that anybody in my shop or anybody in the Revenue Monitoring Committee sees as a viable outcome. And most economists don't see it as a likely outcome. It's more the folks on the financial side that are seeing the V. So just worth noting again, to be fully transparent, what we're talking about here, that's a scenario that we left out because we don't believe in it. So I mentioned withholding, it all comes back to employment. And withholding is directly related to employment. Employment is how all of your constituencies relate to the economy. It's the number one variable in everything that we do. It is what matters. And here again, showing the Great Recession, we lost 123,000 jobs peak to trough in the Great Recession. That happened over the course of 2 years. And then the comeback, right? It took several years for us to get back to pre-employment, let alone where trend would have been. And here we are. We were better than peak employment before this. That was one of the discussion points leading up to this was, employment levels are so low that it told us we were in a bubble, and most of us felt we were in a bubble. It was a matter of when that would become unsustainable. But nonetheless, you see this extraordinary drop off, the bounce back, and then the slow pace of recovery under the two scenarios. And then the table, excuse me, just puts the numbers into magnitudes. And 342,000 jobs lost in S4. And that's looking like the more likely scenario here in the near term. Then you get some of the bounce back, and that's still uncertain. Time will tell, and we'll see. And then the broader recession is kicking in and playing out with more job losses. And you can see that even under S2, we don't get back to that prior employment until early in 2024. And under the S4 scenario, it's not until 2026 that we get back to that prior peak employment. So the jobs scenarios play out over very, very long periods of time under these two models. And we have to remind ourselves that when we're looking at this, that every one of those numbers is a household. Every one of those numbers is an individual. And it's going to be rough out there for quite some time. Looking at the revenue sources that are impacted, this is really detail, and I won't hover on this for too long, but just as you'd expect, the personal income tax bears the brunt of it. That's because the personal income tax is 50% of the general fund. I mentioned withholding was 45%. Your non-wage sources and refunds, make up some of the other aspects, but significant impacts there. Sales tax is obviously directly affected. You have a couple things going on here. You have the stay-at-home order, which is obviously cutting into it. The fact that we tend to tax the items that are more discretionary means that our sales tax is greater affected than some other states. We don't tax groceries. We don't tax medicine. Those are conscious decisions to remove or at least reduce the regressivity of the sales tax. It's a conscious public policy that I know you all have made and we're all very proud of. It does mean our sales tax is hit to a greater degree. This is pushing more purchasing online, right? So thankfully, we're capturing much more of that now. But that does go more to the blueprint fund than it does to the general fund. So it's important to note that this is only the general fund that we're talking about here. I do see those revenue sources from the sales tax that go to the blueprint fund largely holding up here, okay? There's downward pressures on those sources because people are out of work, people are out of money. But at the same time, this is quickening the shift that's been going for quite some time, right, from brick and mortar to online businesses. So, both those factors are playing at cross purposes, but they serve to basically maintain the blueprint funding from the sales tax. The next side is S4, which is the same, but with bigger numbers, okay? But this does help you get to what those sources are. And then this slide here shows historically where the general fund has been. It shows what the forecast was in terms of dollars. And then it shows where these two forecasts take you. And you can see that, under the S4 scenario, you end up all the way back there at about fiscal 15, fiscal 16 levels. The S2 scenario, we're back playing at fiscal 18 levels. So a lot of growth is basically knocked out of this forecast. And significant impact. So I think this chart helps to underlie the budgetary situations in which you all might find yourselves over the next several years. And with that, I'll open it up to questions.
Want to go first, Chairman Kaiser?
Yeah, well, I'm looking around and I'm not seeing the questions yet. So I actually do want to ask a question first while I wait for some other people. In terms of the unemployment picture that you talked about with the two different scenarios being the return to peak levels in 24 or possibly 26, what are the drivers that make you think it's going to take that long to get back to those peak levels?
It's a great question. You know, the downturn in employment is going to play out as different industries start to formulate their response to COVID. And some of it is going to be dealt with through bankruptcy, as we're already seeing. Many major national players are dealing with bankruptcy. And then there are all of the indirect effects of those bankruptcies, right? So every one of those businesses has a supply chain, and each of those has a supply chain. So it will take several quarters for the economic implications to play through. And then the building blocks of coming back, that's where things start to get really muddy. And I would say that's the extreme uncertainty. And first, I want to draw your attention to the fact that those that are most directly impacted by this initially, as I'm sure most of you already know, are the service level direct consumer facing employees. These employees tend to be lower paid in general. They tend to have lesser levels of education and skill sets. And most folks looking forward see an acceleration in the loss of those jobs in the long term. Those jobs have been under pressure even throughout this prior expansion. As the economy continues to transition to a knowledge-based economy and continues to look to leverage technology more and more frequently, both in the forms of AI and in robotics. So it's very likely that as companies adjust their strategies post-COVID, that you're going to see them looking more and more to reducing the human impact on their labor force. And that is greatly concerning to the labor force rebound, and that is built in here to some degree. You know, obviously there's a tremendous amount of uncertainty in that, but these two scenarios, that's why they show such very different levels of that. The S4 would make some assumptions that the employment downturn and correction plays out over a much larger period of time. I typically try not to advocate for specific policies in my role, but as the chair mentioned, as I am moving on, I can speak a little more directly about some of these things. And, you know, if there was ever a time to really buckle down and focus on workforce development, this is it. You know, I think we've been in that neighborhood where we should have been looking at that for many times. And you all have made significant investments in this over this last expansion, rightfully so. But now might be the time to turn that dial up to 10 and really focus on that. We've done some work. It's available on the comptroller's website where we looked at how the labor force has changed since the Great Recession. And we saw that workers aged 45 to 64, many of them never came back. Some of that's related to the opioid crisis, because as we know, all these socioeconomic factors are related. You know, we found in that study that relative to pre-Great Recession, there were 75,000 Marylanders in that 45 to 64 category that used to participate in our labor force that no longer did. And that's because they had lost their ability to contribute at the level they thought they could contribute. They probably were working very low wage jobs, and it just didn't even make sense for them to continue working at that level. There could be drugs at play. So many things, but to put that in perspective, 75,000 fills Ravens Stadium, right? We could literally fill a stadium of the people that were disaffected and throughout this prior expansion could never get back on their feet. It's going to look worse after this. That 75,000 is going to be a much larger number. And while that's a terrible thing to think about, it's also an extraordinary opportunity. And if we can invest in those people and find ways to connect them with the skills that are going to matter in the future, Maryland will be way more competitive than other states. No other state has been able to get on top of this. It's an opportunity for us to lead and to show ourselves, and that will bring employment, and it will show us as a clustering place of employment, and that's a real positive. I'll get off my soapbox on that issue, but I think that relates to your point, Delegate Kaiser, which is that's why this is going to be so drawn out. There's going to be a major correction to the way the labor force looks after this.
Okay, Delegate McIntosh, back to you.
Yeah, we have Delegate Corman has a question. Delegate Corman.
Thank you, Madam Chair. Andy, thanks for the presentation. I've had a little fun lately as a budget dork, being able to explain to people there's actually two BREs, and you're obviously unite them together by statute, your position. But this is all very important, and I'm glad we had a briefing about it, and I watched your presentation to the board a few weeks ago. But do you mind, just since we have you here for this last time, if I ask you a couple of quick questions about the logistics of how the BREs work? Because I think it's, it's a little unusual, like a lot of things in Maryland. Can we just take a couple seconds to go down that rabbit hole?
Happily, yeah.
So I appreciate it. So in terms of the board staff, it's just you. Is that how it works?
Yes, I'm the executive secretary to the board. But then, as you know, in the statute, I then oversee the Bureau of Revenue Estimates, which is my direct staff, and I chair the Revenue Monitoring Committee, which is made up of my staff, other staff from the Comptroller's Office, and then also DLS, the Treasurer's Office, DBM, Department of Transportation, so a wide array of fiscal experts from around the state. So yes, I'm the only direct staff, but then of course I do have some power over my direct as well as the Revenue Monitoring Committee.
And I know the board usually meets, I think it's 3 times a year. I don't think they meet for closeout. Is that right?
That's right. In statute, we must provide the 3 forecasts, one in September, one in December, one in March, and that is to complement the budget process. So September, we give an estimate that helps the governor's staff complete the budget. December, we do another so they can tune it up before they introduce it to you all in January. And then March, another so that you all can make any adjustments that you need to make based on, any updates at that point.
But the day of the meetings is not fixed. It's just any time within those months, and you usually set that?
That's right. Yes. We try to set it based on, sometimes like the one in March is based on whether it's the Senate or the House, whichever's moving the budget, when you plan to make some final decision votes. So we try to get it done, 4 or 5 days before that meeting. But we also try to take some of that timing into account so that we can see the most recent month's revenues. Because at that point, we're kind of just making adjustments based on recent trends. Yeah.
Are the board meetings subject to the Open Meetings Act, or are they sort of a separate?
They are subject to the Open Meetings Act. That's right.
And does the board have its own website? Whenever I need your materials, I go to the Bureau site. Is there a board site?
No, we use the Bureau's website through the Comptroller's Office.
And then I know the last meeting, which was a special meeting, was streamed because obviously that's the world we live in now, but are the meetings typically web streamed?
No, this is, that was the first time. So I think that is, there'll be some positives that come out of all of this. And, I would hope that the board will start streaming meetings or continue streaming meetings going forward.
Yeah, and it's just, this is my last one. Is there any sense on the time frame for your successor coming in and how that hiring process is going?
Not yet, because I think we want to open it up and cast a wide net. It's a very specific skill set. To be the director of BRE, you need to, one, be a communicator first and foremost. Then you need the technical, which is math, statistics, economics. And then you also need a little bit of legal, right? Mm-hmm. And then you need to be able to navigate the politics, and you need to be, one of the keys to the Bureau is that we don't get into the politics. So you need to be able to identify the politics and then avoid the politics. That's critical to this position because we would never want anybody to view anything we do as having any partisanship in it. And that's key. So it is a difficult position to fill in terms of the skill sets, and they'll be interviewing according to that. I have made myself available to be a part of the hiring committee and whatnot. But yeah, there is no formal timeline set for that.
Perfect. Well, thank you again for all your work, and thank you, Madam Chair.
Sure. Thank you,
All
Delegate.
right. The next question we have is from the Majority Leader, Delegate Lutke.
Thank you, Madam Chair, and Mr. Shuffle. Congratulations on the new gig. My question has to do with the governor's vetoes of a pair of revenue bills that passed the legislature this session. So if I'm recalling correctly, Those two vetoes, one of them affected legislation that would modernize our sales tax code. Revenue from that would have gone into, I think, the Blueprint Fund. And then the other one was veto of a tobacco tax measure, which I believe would have gone to the general fund. What's the total impact of those vetoes on our revenue projections?
I would have to look up what the fiscal notes were for those bills. I don't recall off the top of my head. I want to say it was somewhere between 200 and 400, the two bills combined, irregardless of fund.
I think it was around 3.
Was it around 3?
Yeah, total.
They're not reflected here. So since they didn't become law, they're not in the kind of prior forecast baseline, and they're not here. If they were allowed to become law, I guess we'd have to assess what COVID how it would have impacted each of those, but it would narrow the gap a little bit. That's for sure.
Right. Okay. Thank you very much.
Sure.
Chair McIntosh?
Vice Chair Jackson.
Thank you. Can you hear me?
Yes, sir.
Hi. Thank you very much, and congratulations on your future. A couple quick things. One, I'm a strong believer in workforce development, so it's great to hear you mention that. Two, what impact do you see regarding that in the future? CTEs were a part of our blueprint, which got vetoed.
Mm-hmm.
How far does that set us back? And that's something that's an area we need to move into. I'm a product of a CTE sort of a program where some went to college and some went right into the workforce. Secondly, the projection, have you all looked at any projections regarding a lapse in the fall or a recurrence in the fall, and the reaction by our government, federal and state and local governments, from a budgetary standpoint? Thank you, Madam Chair.
Thank you, Delegate Jackson. Let me, I'm going to answer your last question first, and then I'll talk about the CTEs. And I'm glad you asked that question because I forgot to mention it during the presentation. One of the key differences between the S2 and the S4 scenarios is that S4 assumes that that states don't get any further assistance from the federal government. As you know, the CARES money that's been put out there is to be used for COVID-related expenditures, and they have some leeway in how they do that, but it specifically could not be used to backfill the loss in revenues. Should the federal government not step in and give us that revenue, that's why the job picture again looks worse, because now state and local governments across the country have to talk about serious layoffs if that's the case, and then those have compounding impacts.
Right.
So that's a key assumption in the forecast. They both assume, and this is where those epidemiologists being on their team comes into play, they both assumed a wave in the third quarter, okay? But what's important is neither of them assume that there's another stay-at-home order in that second wave. So if there is a second wave, which I believe there will be, I think most people generally accept that at this point, but if there is another stay-at-home order, then you could see another one of these downward spikes, right? And neither one of these scenarios assume that occurs. Now moving on to the training, I was a big fan of the CTEs in the Kerwin plan, and I won't pretend to be an expert on Kerwin in any way, but again, I think it's generally accepted that most felt we needed to get CTE back into the high school curriculum and make that a important focus in high school training. I'll also say I think economics should be taught in every high school. Economics is what makes the world go around, and the fact that we let kids graduate without understanding how the world works, I'd like to see that in there. But when I talk about workforce development, I was more talking about the adult workforce, and I don't think that we should, forget about those folks. They're out there, they're ready to go, and I'll say, Kerwin has a very high price tag, undoubtedly, and there will be a return on that investment. It's a very drawn out time period. if you invest in the adult workforce, I think you could find that you get a much quicker return on your investment that could help pay for Kerwin down the road. For example, if you take folks that are consuming social services, so, you know, I hate to reduce any single individual to a number, but if you look at some folks, they're probably consuming federal, state, and local expenditures of around $20,000 is the usual, is about the average for a household that's consuming social services. And then if you could turn them into, you know, a middle class, lower middle class type income family rather quickly with some meaningful skills training, they're now earning, you know, somewhere in the neighborhood of $45,000 to $60,000 a year, and they're paying about $4,000 to $8,000 in federal, state, and local taxes. You know, you're not just getting that extra tax money, you're also not making that expenditure anymore. So the ROI is huge and it's quick. So I think that's another kind of positive that I see there in the advocacy for the adult workforce training.
Agreed. Thank you again, Madam Chair.
Sure. Thank you, Delegate.
Chair Kaiser, I think I have 3 more questions, so I'll just take them and I'll stop to see Ways and Means people. Delegate Haynes. Delegate Haynes.
Just 1 second.
There you go.
We hear you now.
First of all, good afternoon, everyone. Madam Chair, not only good to Madam's Chair and Madam Speaker as well, good to hear and see you. Congratulations, Andy, on your new change there. Got a couple of questions which you touched on just a little bit earlier, I think, for previous question, but I just wanted to sort of flesh it out a little bit more. And that is with the opportunity for job training. And maybe you're in a position to answer this. Maybe you have not thought about it in these terms, but in good times, we had programs that focused on job training and transitioning workers from certain types of employment into the job sector. Many times the training may be successful, but the problem at the end of the day, there was no pot of gold, so to speak, in terms of a job availability of a job once they reach the end of the rainbow. My question sort of is, when you have certain areas of the state that is really, really service-oriented labor force, if you look at those individuals who work in hospitals, hospitality industry, restaurants, et cetera, and assume that there is a double dip with this virus, so to speak, and we have another stay-at-home order. Are you able to predict how far down or how, you know, what kind of scenario we would be looking at under those circumstances? I mean, I don't know whether you've sort of played that out or not. I mean, obviously, one of the things that this particular stay-at-home order has done is that it has forced companies who are able to equip employees to work virtually to be able to do so. But service employees are not necessarily in that equation. So under with those two factors, what we'll be looking at between S2 and S4, how far down do you think we would go?
Sure. Well, both assume that there is a rough Q3 in terms of the broader recession, but also because of the second wave. If we were to have another stay-at-home order, I think you guys, hopefully you all can see my arrow on the screen.
Right.
You know, I think instead of the Q3 looking like this, it starts to look again like Q2 if there's another stay-at-home order. And then both of these get worse. Another stay-at-home order you will see another, there's going to be companies that get through the stay-at-home order, but by the skin of their teeth, and doubtful that they'll be able to sustain another one. It may be doubtful that they can sustain operating at 50% capacity. So that kind of relates to your point too, Delegate Haynes, in that, even if there isn't another stay-at-home order, service employees, if the capacity limit is 50%, so be it. And now you're talking, you need, all else equal, half the labor force there, right? So already half your service employees are affected. Even if it goes back to 100%, that's one of the questions that we all have on our minds right now. Are we all going to go back anyway? Speaking for myself, I'm still pretty scared. I'd like to be able to bring my kids to see my parents, which means that I really can't get out there and interact with the public because I don't want to bring that to my parents' house. And, so for me, even if they open up to 100%, you're probably not going to see me eating out at a restaurant, right? So there's no way around it. The service employees are going to be, they're going to be decimated by this, and it could be a long-term implication for them.
Hello, hang on.
Thank you. Thank you, Madam Chair.
Delegate Chair Kaiser, you have a committee member with a question. You want to take it back?
I don't even see who it is.
Is it Delegate Rose?
Sure.
Rose
Delegate
up
Rose.
there.
I see you. I don't see a hand up, but go ahead if you have a question.
All right, thank you all, and it's good to see everyone, and thank you for the presentation. Just to follow up on Delegate Jackson and a little bit of Delegate Haynes, speaking of workforce development and forecasted projections and a little bit of the blueprint, I just, as we look at things moving forward and not knowing what we're facing, I think it's become very obvious that we need to equip our kids. We need to make sure we have broadband, but we need to equip all of our kids and future workforce, adults as well, in computer science, using the internet, using technology, moving forward. And my hope would be, as we go back and start talking about all these things once again, if we can focus on those types of things to equip our kids, our teachers, and everything moving forward, I think my personal opinion is we need to put that to the forefront. And these are the type of jobs. And when you talk about where we live, and we're close to, we are surrounded by, DOD contractors, those people by and large have stayed employed, can work from home, and are able to stay and, keep generating income taxes and things of that nature. So I know I saw Ann grin at me. This has been my thing. And I just think we need to really focus on that moving forward. Let's make sure we make computer science education paramount for our kids, get our teachers up to speed, and make that a focus on what we're doing moving forward, especially not knowing what we're facing. And Andy, I do appreciate your presentation today. And I hope that as our numbers continue to do well, I know I feel very hopeful, and I'm hoping that we can all move forward to some sort of new normal. But, I just think that workforce development and looking at things that make sense, we certainly have been through a trial by fire, and I think it's made it all very obvious. So that's just my little 2 cents, but thank you.
Thank you.
All right, thanks.
Yeah.
Comment on that really quick to Delegate Rose.
Sure.
Out of every single recession and contraction is great suffering, and then we get better. The human condition is always one. And that's what drew me to economics, is the behavioral aspect of it, the social behavioral. And, there's a period of suffering and pain, but then we learn from that and we come out of this stronger and better. And I think we'll get there through better broadband, and we get to revisit education and all of these things. And we'll be better at some point in time. It's just the time between now and then is going to be a little rough.
Well said. We have Delegate Solomon.
Madam Chair. Andy, thanks for your presentation and your comments on workforce development. I just had a quick question for you, and I don't know if the data is out there yet, but I think we all sort of anecdotally could figure out what industries and what specific jobs, but is there any data, or do you have any anticipation of data coming out on specifically what careers or sort of future job opportunities we should be focusing on, or, you know, or sort of the
That's a good question.
proof?
Yeah, that's a great question. And, you know, it's hard to see. To me, what seems obvious at this point is that the transition, this is going to accelerate the transition that was already in place. And what that means is continuing to go towards a more of a computer science type future, where what we deliver is service-based in terms of perhaps virtual services and coding and programming and all of those things. We're likely to continue transitioning away from brick and mortar, which will mean more online platforms, more virtual service, and more kind of warehousing and transportation, right? These are all things that were already underway that seem apparent. And then you have the items that we struggled with during this past expansion that will, I think, remain opportunities. And those are your, what I would call kind of the hard skill jobs of construction and HVAC and plumbing. And we know we're at a very significant, we're underperforming nationally in terms of those jobs. And those jobs are needed. They'll always be needed. You know, I think the chance of them being replaced by AI and robotics, they would be way down the line. So those seem like the areas to focus. I don't think the areas to focus for workforce development have really changed a whole lot. But that said, I will not pretend to acknowledge that I know what's coming, because there's going to be a lot that comes out of this that none of us can foresee at this point in time. So there'll be some other opportunities, but I would say it's the ones that were already there before. This is just going to accelerate the need to supplement those.
Thank you.
Mm-hmm.
Thank you. Delegate Kittleman.
Thank you, Madam Chair. Andy, I'm a bit on the other side of this story. I really think you're doing a great job. We need to focus on worst case scenario, because you need to get people in the right frame of mind, because there's going to be a lot of issues. And I have no idea how this particular crisis is going to affect the economy. But I do have a question about using the Great Recession as a model, or, you know, to some extent, because the Great Recession occurred because of the status of the economy. A lot of things were done that shouldn't have been done, and eventually the chickens came home to roost. My impression, and although this is not political, it's definitely philosophical. I've been hearing that we're going to have a recession, you know, for 3 years now, and I keep saying we're not. So you're assuming that there is a recession built into this because of certain things that you look at. My attitude is, if the economy is as good as I have tendency to think it is, that a lot of things have been put in place that make it easier for people to go into business, to have stock, that the likelihood of having a V curve, as it were, is a lot more possible than not. So if you could just address my issues with the comparison of the Great Recession.
Sure. Well, Delegate, the only reason I show the Great Recession is not to say that this will be like the Great Recession. It's simply to your point, just kind of put the magnitude of this into some sort of relation. We all remember the Great Recession very well. So yeah, I don't believe that this recession will relate to the Great Recession in any way, other than to say that the magnitude of it could be greater, could be greater than. or will be greater than. Philosophically, the idea of the V-shaped recovery, I have a hard time seeing that. I don't know how we can put 500,000 people onto the unemployment rolls, even if we're going to bring back half of them this quarter. I don't know how we can do that. I don't know how we can bankrupt so many businesses and limit capacity to so many businesses and bounce back. So far, we're going to borrow an additional about $3 trillion. If they bail out the states, it could be about 4.5 to 5. That should have some economic implications that lower the ability of companies to borrow at preferential rates, which will put a downward focus on investment, which has hiring decisions down the road. So I think that the confluence of so many of these issues are going to come together in such a way that there's going to be orders of effect. And right now we're in the first order. We're early in the first order of effects. And it's going to take some time for it to hit the second and third. And those are when you're going to see the broader downturns, I believe.
Yeah, thank you. Everything you said there is exactly, I agree with you completely. And I think those are the things that are going to really matter. But I just wanted to make sure that it wasn't just based on the way that the Great Recession took a long time to come back.
No, and that's again one of the to add to the uncertainty discussion. We use history to predict the future, and I can't use the Great Recession. I can't use the 90s. I can't use anything that I have in my data. I don't have data on the flu pandemic at the beginning of the century. It's difficult, and I would say that again is why the band is so wide in these scenarios that we have as well. It's contributing to that the width of that band.
Thank you.
Thank you for that. That's an important point.
All right, we did have another question pop up. Delegate Long. Good afternoon.
Good afternoon. Thank you, Madam Chair. Question I have is, with these unpredictable times, what's your thoughts as far as taking a look at working on our infrastructure, trying to streamline jobs, just like it did during the Great Depression. They put people back to work. I'm just curious. I would like to know what your thoughts are on this, and how can we help streamline getting jobs ready, shovel in the state and in the federal. We need to work with the federal partners, that's for sure.
Sure.
For infrastructures.
So I am a Keynesian in that I believe that government should be spending money right now to at least mitigate the downturn. And that's where that federal money, I think, really needs to come into play. And then you as policymakers, again, this is not something I could normally say, but I can now, and that would be, I think you all should be making ROI-based decisions with that, it's tough. Everything might be rethought after this. If people are going to be working more from home and you have less traffic congestion, how does that change your approach to roads and transit in general, right? The same can be said for education. So I can't say that I could tell you where to invest your money, but I think at this point we should absolutely be looking at projects where we can put people to work, especially in the types of industries that have what we call a multiplying effect. So road construction is a good one. When you do some road construction, you have the direct impact of the people doing that work. You have all their suppliers that benefit, which goes all the way, runs the gamut of the supplies to the IT services they buy, right? These investments have broad macroeconomic impacts that create, as I was just saying to Delegate Kim, like the second and third order effects. Those have very positive second and third order effects. But it doesn't mean that we should go building roads just anywhere, because that doesn't make sense. That will eventually be a negative effect. And so I would encourage you to have a framework to evaluate those opportunities if the money does present itself to you to where you can do that, to really, focus on the greatest rates of return that you can see at that point in time, and really do something with a focus towards creating an economic benefit with those dollars, whether that be in schools or in roads. Those are the obvious opportunities. But I think there is a lot of opportunity to invest in technology in the state as well.
Right.
We could continue to better serve our constituencies and serve them more with some investments in technology. So there's some real opportunities out there.
Yeah, you, if I may, I think you did allude to the one question I had was, do you think that our school construction bill would have a similar effect in terms of, job creation and the spinoff that it would cause positively in our economy?
Yes, Delegate. I think any sort of construction has a great macroeconomic implication, for sure.
Right. Thank you.
Sure.
Chairman Kaiser, you want to wrap it up?
No, yes, thank you. I want to thank you and wish you well, and thank all the members for joining. We had all but two of our members, so it was a good, everyone really wanted to hear what you had to say today and really appreciate that. And thank you also, Speaker Jones, for joining us. And if there's nothing else, we'll see y'all later.
Thank you very much, Andy.
Thank you. Thank you. We'll talk more. You guys aren't done with me yet.
I know.
Take care now.
Be good.